When the market crashes, most people just see red numbers. They see their net worth drop 10% in a week. They panic and they freeze. But the tax-savvy investor sees something completely different. They see a coupon. A massive, government-subsidised coupon. Tax loss harvesting is the only mechanism in the financial world that lets you take a position that is underwater, sell it, turn that market pain into a tangible tax asset that erases your tax bill, and then immediately buy a similar investment so your long-term plan doesn't actually change. You still own the market recovery, but you have squeezed the IRS for a discount. It is the closest thing to a free lunch you will find in a bear market, provided you don't trip over the one rule designed to stop you. This strategy is effectively making lemonade out of lemons, but the recipe is strictly regulated. The goal here isn't to sell out of the market and go to cash. That is panic selling, and that destroys wealth. The goal is to stay fully invested while booking a loss on paper. We are going to walk through exactly how this works mechanically, the specific math that makes it profitable, and the wash sale rule that acts as the trap door for people who try to do this without reading the manual. It sounds technical, but it's actually behavioral. Before we get into the IRS code, I want to mention that this is probably the highest ROI activity you can do with your time this week. If you spend 20 minutes understanding this, it could save you thousands of dollars a year in taxes for the rest of your investing life. If you appreciate deep dives that respect your intelligence and your wallet, go ahead and subscribe. We don't do hype here, we just do the math. Now, let's look at why selling a loser is actually a winning move. There is a massive misconception in the buy and hold community that you should never sell anything. We are taught that selling is a sign of weakness or a lack of discipline. And usually, that is true. If you sell because you are scared, you lose. But tax loss harvesting is not about abandoning your strategy. It is about optimizing it. The myth is that a paper loss, where your account value is down but you haven't sold, is safer than a realized loss. The reality is that a paper loss is useless. It sits there, mocking you. A realized loss, however, is a tool. The IRS does not care about your paper losses. They only care when you click Sell. Until you realize that loss, you cannot use it to offset your gains. Mechanically, here is what happens. You bought Fund A for $10,000. The market tanks, and now it is worth $8,000. You have an unrealized loss of $2,000. If you do nothing and the market recovers, you are back to square one. But if you harvest, you sell Fund A at $8,000. You realize the $2,000 loss. That $2,000 goes onto your tax return as a deduction against capital gains. But here is the key. You immediately take that $8,000 of cash and buy Fund B. Fund B is similar to Fund A, maybe a different brand of S&P 500 fund or a total market fund. You are still invested. If the market rips higher the next day, you participate in the rally with Fund B. But come April 15th, you have a $2,000 credit in your pocket. The reason most people don't do this isn't because the math is hard. It's because it hurts your ego. To harvest a loss, you have to admit, mathematically, that you lost money on that specific trade. Humans hate finalizing a loss. We prefer the fantasy that it will come back while holding the original asset. It feels safer to hold the bag than to dump it. This is called the disposition effect. We hold losers too long and sell winners too soon. Tax loss harvesting forces you to break that psychological flaw. You are actively realizing the loss, but you are reframing it. You aren't admitting defeat, you are banking a tax asset. You have to separate your emotional attachment to Fund A from your financial goal of wealth maximization. The protocol for this needs to be precise. You cannot sit in cash. If you sell Fund A, wait 3 days, think about it, and then buy Fund B, you are taking on market risk. In those 3 days, the market could jump 5%. If that happens, you just lost more money in missed gains than you saved in taxes. The execution must be seamless. Sell and buy in the same trading session. Ideally, almost simultaneously. You want your time out of the market to be measured in seconds, not days. This ensures that your portfolio's beta, its exposure to the market moves, remains constant. You are changing the vehicle, not the destination. Now, you might be thinking, Tom, I don't have any capital gains this year, so this is useless to me. And that is where most people stop. They leave thousands of dollars on the table because they think losses only offset gains. That is wrong. The IRS has a rule that allows you to use these losses against your actual job income, your salary. But there is a strict limit. If you ignore this limit, you aren't just missing a tax break, you're missing a cash flow upgrade. Here is the rule regarding ordinary income. If your capital losses exceed your capital gains, or if you have no gains at all, the IRS allows you to deduct up to $3,000 of that net loss against your ordinary income. That includes your W-2 salary, interest income, or business income. $3,000 might sound like a rounding error if you have a large portfolio, but think about the tax rate arbitrage. Capital gains are usually taxed at 15% or 20%. Ordinary income can be taxed at 32%, 35%, or 37% at the federal level, plus state taxes. Being able to wipe out $3,000 of income at your highest marginal rate is incredibly efficient. Let's run the numbers on that $3,000 deduction. If you are in the 32% federal bracket, and let's say a 5% state bracket, your marginal tax rate is 37%. A $3,000 deduction saves you $1,110 in cold hard cash. That is over $1,000 the government effectively pays you just for clicking a few buttons to swap funds. If you do this every year for a decade, that is over $11,000 in tax savings, not including the growth on that money. And remember, that is just the limit for ordinary income. There is no limit on offsetting capital gains. If you have a $100,000 gain from selling a house or a winning stock, you can offset that entirely if you have enough harvested losses. Here is the twist that makes a market crash valuable. What if you lose $50,000 in a crash? You can only deduct $3,000 against your salary this year. So, do you lose the other $47,000? No, you carry it forward, indefinitely. It becomes a tax asset on your balance sheet that rolls over to next year and the year after that. It sits there, waiting. 5 years from now, if you sell a rental property or rebalance a winner for a $40,000 profit, you can pull that old loss out of the bank and wipe out the tax bill completely. You are effectively prepaying your future taxes using the misery of today's market crash. So, the strategy during a deep drawdown isn't just to harvest enough to cover this year's taxes, it is to harvest as much as humanly possible. You want to build up a massive war chest of carryover losses. I look at my carryover balance like a savings account. If I have a huge carryover loss, it gives me freedom. It means I can rebalance my portfolio later without fear of tax drag. It means I can sell a high-flying tech stock without handing 20% to Uncle Sam. You are banking the loss now to buy flexibility later. Don't be afraid of generating a loss that is too big to use this year. That is actually the point. However, the IRS is not in the business of handing out free money without a catch. They have a specific rule designed to stop you from gaming the system, and if you trigger it, your entire tax deduction vanishes into thin air. It's called the wash-sale rule. If you get this wrong, you don't just lose the benefit, you create a messy accounting nightmare that can haunt you for years. And the trickiest part? It applies to trades you might not even realize you're making. The wash-sale rule basically says you cannot sell a security at a loss, and then buy a substantially identical security within 30 days before or 30 days after the sale. That creates a 61-day window around your trade. If you violate this, the IRS disallows the loss. You can't claim it on your taxes this year. Instead, that loss gets added to the cost basis of the new shares you bought. It's not gone forever. You get it back when you eventually sell the new shares. But the immediate tax benefit is dead. The government wants to prevent you from claiming a tax loss while maintaining the exact same economic position. The confusion comes from the phrase substantially identical. The IRS has never strictly defined it, but we know the guardrails. If you sell the Vanguard S&P 500 ETF, VOO, and immediately buy the iShares S&P 500 ETF, IVV, that is almost certainly a wash sale. They track the exact same index. They are substantially identical. However, if you sell an S&P 500 ETF and buy a total stock market ETF, like VTI, the consensus among tax professionals is that this is safe. They track different indices. One has 500 companies, the other has 4,000. They are correlated, they move together, but they are not identical. This nuance is your loophole. Here is the psychological trap, or rather, the automation trap. Dividend reinvestment. This is the most common way smart people trigger accidental wash sales. Let's say you sell a stock on December 15th to harvest a loss. You plan to stay out of it for 31 days. But in your IRA or a separate account, you hold that same stock, and on December 20th, it pays a dividend which is automatically reinvested to buy more shares. That tiny purchase, even if it's just $50 worth, can trigger a wash sale rule across your accounts. The IRS looks at all your accounts together. You need to turn off automatic dividend reinvestment for any security you are actively harvesting. The solution is to map out partner pairs before you ever click sell. You need a primary holding and a secondary holding for every asset class. If your primary is an S&P 500 fund, your partner is a total market fund. If your primary is an emerging markets fund from Vanguard, your partner might be a FTSE emerging markets fund from Schwab that tracks a slightly different index. Write these down. When the crash happens, you don't want to be researching fund correlations. You want to execute. Sell A, buy B. 31 days later, if you prefer fund A, you can sell B and switch back, assuming B hasn't dropped further. Or just keep B. If they are similar enough, it doesn't matter which one you hold long term. Now, the skeptics, and there are plenty of them, will tell you that tax loss harvesting is a scam. They say, "Tom, you aren't avoiding taxes, you are just deferring them." And they are right. When you sell and rebuy at a lower price, you lower your cost basis. That means when you eventually sell in retirement, your gain will be bigger, and you will pay the tax then. So why bother? Because they are missing the most powerful force in finance: compounding on the government's dime. Let's address the deferral argument. Yes, by harvesting a loss, you are lowering your basis, which increases your future tax liability. But you are trading a tax bill today for a tax bill 20 years from now. That is an interest-free loan from the US Treasury. If I can save $3,000 in taxes today and keep that money invested, it can compound at 7 or 8% for decades. The growth on the money I didn't pay to the IRS belongs to me. This is the time value of money. Paying $1 of tax in 2045 is infinitely better than paying $1 of tax today. There is also rate arbitrage. You are likely harvesting losses during your peak earning years. You might be in a 32% or 35% tax bracket. You are using these losses to offset income or gains that would be taxed at those high rates. When do you pay the deferred tax? Ideally in retirement, when you have no salary. Your capital gains rate in retirement might be 15%, or for many married couples, even 0% up to a certain income level. You are harvesting a deduction at a high rate today to pay a tax at a low rate tomorrow. That spread is pure profit. It's not just deferral, it is optimization. And finally, there is the ultimate loophole, the step up in basis. If you hold these assets until you die, the cost basis resets to the market value on the date of your death. Your heirs inherit the assets tax-free. All those deferred gains? Wiped out. All that future tax liability the skeptics warned you about? It vanishes. In that scenario, tax loss harvesting wasn't just a deferral, it was permanent tax avoidance. Obviously, dying isn't a great investment strategy, but for long-term legacy planning, it turns a temporary benefit into a permanent windfall. So, is it always right? No. If you plan to sell the asset in less than a year, don't bother. You'll just reset the clock on short-term capital gains, which are taxed higher. If you are in the 0% or 10% tax bracket, the benefit is minimal. But for anyone in the accumulation phase with a taxable brokerage account, ignoring tax loss harvesting is like tipping the IRS extra just for fun. You don't get a gold star for overpaying your taxes. Next time the market crashes, don't panic. Look for the silver lining. Look for the losses you can harvest. Take the government up on their offer to share your pain. Keep your asset allocation steady, watch out for the wash sale rule, and bank those carryover losses for the future. It's the one time in investing where losing money actually feels like winning. If you found this breakdown helpful, leave a comment about how you handle market dips. I read all of them. Thanks for watching, and I'll see you in the next one.